What goes up must come down. And right now, interest rates are rising. So does that mean your bonds values are falling? Jim Lineweaver is here with the ins and outs of these ups and downs. Jim is a certified financial planner professional with the Lineweaver Financial Group. Welcome back to the show.
Good to see you again.
So remind us again the interrelationship between interest rates and bonds.
Well, this is where opposites truly attract because what happens is as interest rates go up, bonds go down because they need to adjust to make everything equal to that new interest rate pricing. So unfortunately, what ends up happening is that if you're not careful, if we get too many of these rate increases, what you thought might have been a safe haven in bonds could start to deteriorate your portfolio.
Ooh, so I guess if we've invested in bonds, we need to start worrying?
Well, I would say more be aware of how the bonds are structured in your portfolio, because what ends up happening is that there's ways to get around this, and we'll talk about some strategies, but there has been a little bit of a flight to U.S. Treasuries because there are other parts of the world that aren't seen as sound as we are, you know, despite what's going on. You know, about, believe it or not, we are seeing there's more emerging markets and stuff. We're seen as a more sound economy. So our Treasuries have been doing well, but what's going to happen is that could unravel over time depending on how fast they do raise interest rates.
Okay, you mentioned strategies, so what types?
Well, one is Treasury inflation protected securities. So you can actually buy these things called TIPS, and what they're going to do is they're automatically going to adjust to inflation based on the consumer price index. And what they're going to do is they're going to index that bond twice a year. So if they measure inflation from when you purchased it 6 months out, they'll actually look at seeing if there's any inflation, and they'll make an automatic adjustment to the bond. So over time, you could stay ahead of inflation. You wouldn't necessarily get penalized.
Okay.
There's also a way that you can look at corporate bonds. So if you buy a bond fund, you're going to be subject to more price fluctuation. If you buy an individual bond, you can hold that bond to maturity, and no matter what happens during the time until it matures, up or down, you know, as long as you buy a good quality one, so you don't want to buy junk bonds here, you want to buy investment grade or higher, but what happens is as long as you hold that to maturity and there's no default, you're going to get 100% of your money back, plus you got the coupon or interest all the way through.
Okay. Is there something called a triple tax-free bond?
There is. So if I'm all for paying my fair share to Uncle Sam, but I don't like to pay a dime more than I have to.
Exactly.
So if you actually buy like a local municipal bond, what you can do is you can get federal, state, and local tax-free income, which can be really good if you're in a higher tax bracket.
Okay. And there is a third smart investment tip, buying single municipal bonds?
Well, it can be any individual bond. So we call this actually a bond ladder. So what happens here is you're trying to say, okay, I like maybe some of the current interest rate, but I know interest rates are going up in time. So how can I take advantage of that? And we looked at putting maybe, 20% in bonds that are going out about 5 years. And so you can see a 2-year bond would only be at 1.2%, 4 years at 2.5%, but you're getting out to 6 years, now all of a sudden you're up to 3.8, starting to get attractive. But you don't want to put all your money in there because you might need money in the meantime. So if you ladder these like every year, then you'll have a bond that actually or two that actually mature, and you can actually then, as soon as it matures, roll that into another 5-year bond and get a little higher interest rate, and just keep that going so you'll not be penalized in a rising interest rate environment. Okay,
and you always have something ready to go to move into a better interest rate. So.
Exactly.
You mentioned that these are single bond funds, but are there opportunities with, like a bond fund?
Yeah, well, sorry, these were individual bonds we just talked about. Now, if we're talking about a bond fund, you can do that where a manager is going to maybe have, 100, 150 bonds inside there, sometimes even thousands. But what happens is you want to stay with a shorter duration, because a longer duration, if you're going out 20, 30 years in some of the bond funds, longer term, you're going to have a bigger price fluctuation. So stay shorter term, and some bond funds even go globally. So they're not only divesting in the United States, but they can pick other countries throughout the U.S. and also help you diversify, because interest rates may be going down in other countries while they're going up here, and you can get the opposite effect and really help out your bond portfolio.
Okay, just take some planning, right?
Exactly.
All right. You don't have to break your bond with bonds just because interest rates are rising. Follow Jim's tips to keep your bond investments on track, or call him for more information or for a no obligation analysis. The number's next.
For more information, call the Lineweaver Financial Group at 1-888-313-4009 or click to www.lineweaver.net.